Alright guys, welcome back to my channel, and in today's video I'll be doing the second part of the liquidity concept, and the second part is actually titled understanding and identifying types of liquidity. So I just want you to know that in a nutshell, in the market generally there are two types of liquidity. And the first liquidity, just like I wrote here, the first liquidity is the external range liquidity. That is what most people do write as ARL on their chart, and is generally called the buy side liquidity. So I'm going to explain. Then the second type of liquidity is the internal range liquidity, which is called the IRL, which is generally called the sell side liquidity. So the external range liquidity, just like we know that the candle market, the forex market, is actually divided into three kinds of markets. We have the uptrend market, the downtrend market, and we have the consolidating market. And we know that what drive price is actually the liquidity. Just like I said in the first video, that liquidity is actually the petrol of price that allow price or aid price moves to a particular level in the market. So examples, or should I let me just give you like an illustration of what the external range liquidity is here. So when you have an uptrend market in this manner here, this is an uptrend market. Because this market is going in this way, it's actually going out for, because we have markets pushing out this way, it's pushing out externally, and when price should come down, it's coming down to an internal range. But let me just explain this again. Now, external range liquidity is when price actually push for liquidity at an external region. External region is like a region outer, like an outer region. So let me just do like an illustration. Just watch. Let me just draw something for you guys before I explain. Let me shift this one side. Just be patient with me. I want you guys to understand this. Let's just say we are in an uptrend market, and the market is going up, going up, going up, going up as at to this level. Let me look at this. So if you look at this market now, price is very, very bullish here. You can see this is an uptrend market, and if you notice, price has been pushing up externally. Like, you know what the word means now? External means going out. Yeah, so price has been actually going upwards, just like we have in this market here. You know that when price is going up, it's going externally for external liquidity, and when it's going down, it's going for internal liquidity, external liquidity, internal liquidity, external liquidity, internal liquidity, just like that. External liquidity, internal liquidity, external liquidity, internal liquidity, just like that, guys. So when you see price actually going up for a very long time, you know that price is going out to take an internal liquidity. Then ideally, using this picture, you know that this is what we have here. This is what we have here. So let's just say this is where the market starts from this line. And you notice that for a very long time, price have not traded into this region. Price have not traded into this region. What do you think could be below this region? This would be liquidity in this region, because for a very long time. Okay, let me shorten this arrow. Yeah, bring in another arrow so that you see what I'm doing clearly. So from where the market starts here, we know that the way price is actually going is actually taking in external liquidity and internal liquidity, because it's actually moving in a zigzag manner up and down. When price is going out, it's taking out external liquidity from old highs. That's the buy side liquidity, where you have your buy orders around the old bullish order block or bearish order block. You just understand what I'm saying. So price is pushing up for external liquidity, coming in for internal liquidity, pushing up like that in that range. Yes, price is actually doing something, but in an in this overall view, you can see this gap here. There's a whole gap here that price have not traded into for a very long time. There's a whole space that price have not traded into for a very, very long time. So we have here that when price actually starts coming in inside here, it's actually coming down to take an internal range liquidity. Look at this now. Price is actually coming down to take internal range liquidity in order to balance price action. If you want to continue going up from here now, it's all good, because for some reason we have balanced this price action. Let me increase the time frame so I can get enough space. 1 month. It's very big. So for some reason now, price have actually balanced this market here. So if price want to continue going up from this level, it's all good because we've come down to take in the internal range liquidity. The act of price coming down like this into this range is actually coming in to take an external range liquidity. Why? As it's going up for external range liquidity. Meanwhile, why price is moving in a zigzag manner is actually taking liquidity internally and externally, just like I explained here. But what we are talking about is the overall liquidity. Because if we are pushing up, we are pushing up for external ranges. Yeah, we are going for external price. So the process of going up is as to take an external range liquidity. Then the process of coming down here is to take an internal range liquidity. And if price should continue going up again, it's actually taking liquidity that is above here, which is an external liquidity, which is actually going to continue doing like this, just to make sure that it has taken all the liquidities. And if you notice here now, we have that price is actually trading overall in everywhere. So there's no blank space like that. So with time, price is going to trade below here in order to completely take the external range liquidity that has been formed here. So price will completely come down so as to take out liquidity. Now, liquidity that was formed below here. So this is how price action works. So this is how you just have to understand the concept of liquidity using the higher time frame. So let's go to the forms of liquidity because I've actually explained external liquidity and internal liquidity using this schematic diagram. So let's go back to this one. And we have the forms of liquidity are old highs or old low. That's the first form of liquidity you see in the market. Now we know that we have generally two types of liquidity, which is the external range liquidity and the internal range liquidity. So for the external range liquidities, because we are moving up, let me use this thing, because we are actually moving up for the external range liquidity. So the kind of liquidity we'll be having is the higher prices, like we'll be having liquidities on the highs because we are moving up. We are moving up. Let me bring this thing here. Because we are actually going for higher prices, external range, because we are going for external prices. We'll be having liquidity above the highs, liquidity above the highs. So if price should trade above the high, we know that price is taking out liquidity is what we call the breakout structure. But in a way, price is taking out liquidity because it's actually going for external range liquidity. So let me continue drawing. So because we are actually going up, we are getting liquidity above this high, so as to call it external range liquidity. That's how old high can actually be a form of external range liquidity, and for the old lows too can actually be a form of liquidity. Let me show you here. Now you can see this is a very old low that price have not traded into. This is a old low. So when price trade above or below here, that means price is actually taking out liquidity from here. Price is taking out liquidity from this low. That is just the whole concept of liquidity to mitigate those places. So we have old lows here. These are old lows, which is a type of internal range or a form of internal range liquidity. Old high is for external range liquidity because we are pushing for external prices going outwards for external prices. So above all these highs here, we have liquidity, just like price led to liquidity here now above this high. So as it's going for liquidity below this low, it's going for an internal range liquidity because it's coming internally, internal coming in. So we have liquidity below this low, which are is a form of internal range liquidity. So a old high, this old high, yeah, an old high is a form of external range liquidity, while the old lows are a form of internal range liquidity. So I believe you understand what I was trying to say there. Then this old high can actually be PYH or PYL. What it means is that this old high can actually be previous year high or previous year low, previous month high or previous month low, previous week high or previous week low, then previous day high or previous day low. So these old highs can actually be any of these high. So if you're trading and you have something like this here, and let's just say this high or this chart is actually represented in a weekly time frame. We have this high to be a weekly high, previous week high. That's what I'm just trying to explain. So this can actually be a previous week high too. So we have liquidities above here. Then these lows can actually be a previous weekly low. And for all this low, we have that price can actually come in to take out any of them. Just like price can go to sweep liquidity above the previous week high, then come back for liquidity below this previous week low, so as to continue moving upward. So that's just it. So price can, it depends on the time frame you're using. So if you're using the 4 hour, you have the hourly high and low. If you're using the daily chart, you have the daily highs and low as your liquidity target. All this I'm going to show you in a real market structure. Yeah, in a real market structure. But for now, let's be using the schematic diagram. I think it's still easier to explain. So we have the price to count liquidity from the previous week or previous day or previous month, any time frame you're using. So liquidity below the old low or old high, any one you're using is actually convenience for you. So another type of liquidity are called the inducements. Now guys, you really have to listen, because inducement is something that is confused people a lot in the market. So let me explain what an inducement is with a diagram. Now you need to understand everything I'm going to say, and you just need to take it calmly. Now in a range of price is a high and a low. Listen, a range of price is a high and a low, because price range is actually a range between price at two levels. And for price to have a range, how am I going to explain? Just like from the range of 1 to 10, you're looking at a range is actually 1 to 10. Let's just say this is the low and this is the high. Then this first box here is where we have number 1. This is where we have number 1. Yeah, this low is actually 1, because price is moving up. You are going to have higher prices, just like we have this range from 0.9500 by your right hand here, just like we have this range, and 0.9500 to the range of 1000. So let's just say this is our range here, from 1 to 10. That's a range in price. A low and a high is actually a range in price. So we have a range like this. Now within the range of this price action, yeah, let me explain. Any liquidity found within this range of the low and the high is actually called an inducement. I come again. Within a range of price action, any liquidity found within this range is actually called an inducement. Now we know that liquidity can be found or can be in form of a high and a low. So any liquidity found within this range is actually called an inducement, in the sense that if we have price action within this high and this low, in terms of like this, let's just say price is going like this within this range, you see something like this. Let's just say price is actually trying to go bearish, then you see price do something like this, take out the mini high and come down, goes up and come down again, then go up, come down, go up, come down, go up, come down, take out the main liquidity, then continue going. Look at this. Now within this range, guys, look at this. Within this range, we have all this high within this range to be inducement. This is an inducement here. This is number 1 inducement, because it's within the range. This old high too is within the range, which is an inducement. And you see price took it out here. Price took out the liquidity here from that inducement. So look at here again. This is an inducement here, because it's a high within this range from 1 to 3 here. This is an inducement here. So price took out liquidity above that high. Look at this other one too. Look at this one. This is one of the simplest example. You see, this is an inducement too. This low too is an inducement. This low too is an inducement. So price took out this low. Price took out this low. Then this other low too is an inducement. This other low too is an inducement. This old low is an inducement. And price took out this inducement before heading down for this overall liquidity, which is the old low. Now let me explain something for you. The main aim of all these inducements is actually to help price go to its final direction or its final objective. Just like we know that this low is the final objective for price to come, that the liquidity below this low is the final objective for price to come and sweep. We know that price is actually going to build more liquidity to aid it go to its final destination, just like we know that liquidity is what help price go to its destination. So price have a way of constructing its own liquidity. Why? So that it can help it go down to the final direction. It's just like this old car game we used to play back then in our Java phone. You see our fat car racing game, this car racing game, where we have some kind of nitro booster on the part of the race here. So if you drive into those nitro, it will help you boost your speed for at least 3 to 5 seconds in order to get to the finish line faster. That is the work of inducement, because these inducements help push price. And you see, for every reaction in this inducement, you see price move massively. So as price took out this inducement here, see the push it did here, it gave a massive push here. So price was actually going until it took out this liquidity above here, which is called an inducement. This old high, it actually pushed again massively, took out this liquidity, this inducement, it reacted upwards. Because for every liquidity price take, there will be a reaction. It's just like for every push or for every petrol you put in a car, this it is expected that the car move to a particular destination until the petrol is finished. So for every liquidity price take, is actually going to react by giving you a move. So price took out this liquidity here, which is an inducement, and the overall liquidity on the old time low, which can be the daily low or the weekly low or the previous month low, and you can see the move this low because it's an old time low. It gave rise to this massive push here. That is the work of an inducement. I believe this example is quite understandable, very, very understandable. And the same thing happens in the bullish market, because in this picture now, you're actually looking at it at the bearish market. Now, how do you even know that you're in a bearish market? You use from a higher time frame. You use a higher time frame. Let's just say this is a 4 hour you're looking at price from. You're looking at price from a 4 hour, and you see something like this happening. At times the trend of the market is what is going to help you, because you actually want to trade in the trend of the market. Now let's just say this is a higher time frame market, and the overall trend is bearish. The overall trend is bearish. When price is actually taking out inducements, you don't want to be confused on what to do. You want to actually follow the overall trend. So since price have actually taken out inducement and it broke structure here, this is a break of structure because it broke the old low. Now you formed a new range downward because price did not break out from this range upward. Price did not break out from this range upward. It actually broke down. So you've now formed a new range because you broke out of the old price, which is one. You're now actually going to go lower. So you know that you're going to go lower. You just want to look for the perfect liquidity spot that price is actually heading for. If you cannot actually meet up with this old high, so you're actually looking for the perfect liquidity spot to take your trade from. And if you're looking at it here, the liquidity that can actually push price in the overall trend can actually be liquidity above this high or any of this old high or this inducement here. You want to see a reaction from there. So let's just say you draw out liquidity here. So you're expecting price to actually react from there. Then you see how price goes into that liquidity area and actually give you your move. Let's just say you see something like this. Let me delete this. Now, people will always get confused in the market, those that don't know how to identify the trend of the market. Because when they see something like this, when you see something like this now, you can actually feel like, yes, market has changed to a bullish market and you want to start buying completely, not knowing that market is actually going for an overall liquidity to continue its trend downwards. Because you can see the structure there and think that is a bullish structure now. Oh, sorry. You can see structure here and think that is a bullish structure, not knowing that we had a current break of structure to the downside, which is this here. In as much as price took out liquidity, it has created a break of structure to the downside and is now going to be selling because we broke out lower. So we are expecting lower prices. Yeah. So price actually took out this liquidity, this very liquidity, in order to push down completely. So price took out this liquidity in order to push down completely. So you buying from here can be very risky because you're actually going to feel like we have changed a trend, not knowing that the overall trend is bearish and all these things the price is doing is just building liquidity above here. So now we now have a new range, and in this new range, this is the high, and anywhere the low stop is actually going to be the low of the market because we've broken out from that very old low. We're breaking out from that very old low. So that will be all on inducement. So this is now actually going to be the new range. Let me mark it out for you so that you understand in the chart. Maybe when you're trading personally. So you now have here to be your low. That's your new price range. You have here to be your low, and you now have here to be your high. Now, it's now left for you to identify the inducement within this new range in order to trade with to continue the trend. So if you then see something like this, then you know that it's actually very, very correct to have market prices go up, go up, go up, go up, then come down, take out liquidity, go up, just like this. It might be very disturbing, but you know what you're aiming at, that you actually want to join prices downwards, not something you get confused. I want to see if I can actually shift. Sorry guys, sorry guys. So in this new range now, you just have that price has created enough inducement, and you want to just look for the perfect one that is going to push price for you. So imagine you met price action around here, just because you understood that price broke lower here. You understood that price broke lower here. Let me show you. You know that this is a break of structure here. It's the break of structure to the downside. And this is the second time you're having a break of structure. So you know that this market is actually bearish, and you will not be carried away by what is actually going on inside here, inside your range, the overall range. You will not be carried away by what is going on inside here. You know that the overall trend is bearish because you have break of structure one, break of structure two. So you're expecting price to actually push further. All what you're looking for is the liquidity that is going to give rise to the main push. Then look at this now. Inside here, this is an example of inducement. I've explained a lot. All these old highs, you have this one to be an inducement. See how price reacted after taking out this inducement. You also have this one to be an inducement to the downside. Like, you see this inducement here. All these are examples. So you just want to look for the best price, and maybe this was where price found enough liquidity to push down, taking out the overall objective, which was this old low. So it's the same thing for a bearish market. It's the same thing for a bearish market. Everything is the same. And the next example we'll be talking about here is okay, is the IFVG and FVG. So I will just explain what these are. This the meaning of IFVG and FVG for, as a kind of, or as a form of liquidity. Then we have the last example of or form of liquidity to be engineered liquidity. Now, IFVG and FVG are fair value gaps, and you know fair value gaps is something that happens when you have a three candlestick price action. Before I even go to the IFVG, I want to show you another example here of how I drew out inducement on the schematic diagram too, and it was actually what I used to lecture in the last class. So let me just show you on that chart. That was an NZD card. Look at it here, just the same way I explained in the last class. Let me go to a daily time frame so you can see it clearly. Are you seeing, guys? This is how I just finished explaining for you, where I told you the lows and the high within the range are the liquidity. And see, we have here, look at, I marked here inducement, I marked here this old low inducement, I marked this old high inducement, I marked this old high inducement, and you can see where price took out the liquidity below this old low, giving you an overall break of structure to the downside. Then price continued creating a new range. This is the new range where we have this high and this low. And within this high and low, price took out this overall liquidity, pushing down again. We have here to be an inducement. We have here to be an inducement. So their inducement are mostly in double top, or something like this, just one top. That's double high or one high, double low or just one low. So inducement can be in many forms. But as far as it's within a range, you know that this is inducement. So let us go to the other form of liquidity, which is the engineered liquidity and the IFVG and FVG as a form of liquidity. Now we know that FVG is a three candlestick movement that causes momentum. That is caused when you have a three candlestick movement with a momentum. Let me just look for an example. Now you look at this chart here. You see that we have a three candlestick momentum, and we have this to be an FVG. Let me show you a three candlestick movement, and using the first and the third candlestick, you want to see a gap in between there, and that gap is actually the gap, the fair value gap. So we have candlestick one, candlestick two, candlestick three, and you see that the shadow are not both joining, just like these ones are joining. You see the shadows are not both joining, which means that there is a fair value gap price here. So there's a push in price action that did not make it trade completely, and this gap is actually called liquidity void. This gap here is actually called liquidity void, and price always tend to fill up the liquidity void. Liquidity void in the sense that when price is actually moving, when price is actually moving, it's supposed to close completely with its candlestick body, or using its wick when price is actually moving forward. And what is to actually cause this impulsive candlestick is due to the large order. You know, the healthy candlesticks are actually being caused by large orders, and these large orders is to make price move and not give a fair price action. So when you have too many orders, you tend to leave gaps in the market, because this is a push in candlestick here. It's caused by a large order or large set of traders entering, creating a bullish momentum, leaving up this gap here. And because you're leaving up a gap, price have not completely traded into to fill up this gap, which is leaving an unfair price action, which is called the fair value gap here. So we also have another fair value gap here, And if you see we have candlestick one, this bearish candlestick two, three. I'm not here to teach you fair value gaps. I've taught fair value gaps. I'm just here to explain how it can be a type of liquidity. It's actually known as the liquidity void here. The gap is known as the liquidity void because we have a massive order. This bullish candlestick now you see here, this bullish candlestick here is actually showing you the momentum of traders that enter this market after this bearish candlestick, which is showing you the traders that try to sell around here. So we have enough traders that pushed up these candles like this. So they let an unfair price action, and you see that after price must have traded in a very long time, it came in to fill up this gap. Filling up the gap is a process of mitigating liquidity because we have enough traders entering here, there will be enough liquidity here in this gap. So when price comes to taking or fill up this gap completely, it's actually mitigating liquidities that cause the momentum. Money is liquidity. Traders use money to enter the market, is what pushed this price. So as price came in here, it actually took out most liquidity that was here, filling up the imbalance because it's due to the momentum or the volume of traders that enter the market around here that created this liquidity void. That is what it is called, liquidity void. And most time liquidity void can also be caused by the impact in economic release, just like we have in this candlestick here, this very large candlestick. You can see how bogus it looks here. So this was what happened during NFP, and we know that within the time, price is actually going to retrace because we have enough liquidity from here down to here. Yes, so this is the liquidity void, and with time, price is actually going to retrace, to balance up price action and to continue selling. So that's just it, taking out all the liquidity around there. So that's just what fair value gaps and IFVG are as a type of liquidity. So if you don't really know how to identify them, you can just go to my YouTube channel to watch more videos on IFVG and FVGs. So let's go back to the AUD card where we use for our explanation. Now, the last type of liquidity is also known as the engineered liquidity. So the engineered liquidity is also known as the constructed liquidity. Yes, it can also be called the constructed liquidity. So the last form of liquidity is the engineered liquidity here. And the engineered liquidity, from the word engineered, is either engineered. Engineering is actually talking about construction, repairers or something, but it's actually known as engineered liquidity or constructed liquidity. Now, this engineered liquidity are liquidity that market obviously built on its own. It's not even in the case of this inducement here. Is we know that market actually builds all liquidity, but we know that there are other liquidities that we know that market gradually build them. Now that liquidity can actually be mostly in form of trend line. Those liquidity are mostly built in form of trend line, or you have resistance and support line. Yes, these are the three forms you can actually see this liquidity in: resistance and support line, or trend line. Now I'll explain for you. And I wish I'll be able to give examples, but the videos is actually talking about identifying and understanding liquidity. So bear with me if I'm actually taking enough time, because how to do the identification on the real chart is not all about using schematic diagrams. So trend line can actually be in two forms, which is the up and down. So let me draw another trend line. So this liquidity can actually be in this form. Now I'm going to show you. Now it doesn't have to be inducement or something. This one is for the three types of market. So we have engineered liquidity. This is what price can actually be. It can actually be on any time frame, 5 minutes, 1 minute, 1 hour, 15 minutes, any time frame you see liquidity is liquidity, not minding the time frame. So when you see price actually moving in this way, watch. You see something like this. So we have price action to, like, let's just say price action starts from here, then it gets here, moves, gets here, come down, push, push here, stop, push here, do something like this. I just want you to look at what I'm doing, so just bear with me. Let's extend it so I can be fast. Are you seeing what price is actually doing? It's taking note of this resistance and support line, and it's gradually building liquidity on the both side. Because I said in the first video that liquidity are most on places where price have not traded above or into in a very long time. So this is a very good example of a built liquidity, or an engineered or a constructed liquidity. Look at how price did this work here. So you see, price is taking note of this particular low, this particular range, and for some reason, because it's building liquidity, it has not traded below this low. Yes, I know it's actually going to build inducement within this range in order to help price go. Inducement in what I mean that this low now is an inducement because it's between this range, and this high is an inducement. You know, price has to build liquidity within this liquidity range in order to move you. There have to be liquidity for price to actually push. So why price is taking out liquidity below this low here at this level? is actually going to give rise to this push. So price will come down, come down, come down. But for some time, when price constructs this liquidity on the both end, at a very given time, you are going to see how price is going to push forward for the both liquidity, something like this. Now, the liquidity is actually going to be, um, the main move is actually going to go in favor of where the market is. Like, what kind of market is this now? Because we know that this is an uptrend. Because ideally, you've seen that from here, the market is actually going up from here. This is supposed to be an uptrend here. Don't mind my drawing. It's something I'm explaining, so I might not really get it right. So this is an uptrend. You know that this is an uptrend. So the market is actually going up from here, and before that we have this consolidation, which is also known as the constructed liquidity. We have this consolidation. We have this consolidation here that market formed here. So because we are in an uptrend, we still expect price to be bullish. And before price can actually go bullish, we have to take out liquidity. And this is what you now see. Price is not actually going to take out this liquidity and push downward to take out this other liquidity. Now the liquidity below here from this low, this low, this low, this low, this low is what is actually going to give rise to the momentum in price action to as to go to its higher destination or its final destination. That is just the simple logic. Now this is the example one of a constructed liquidity. Example two of a constructed liquidity, which are mostly in trend lines here. So you see that price is actually going to do something. Now, most of you know this kind of entry strategy where they call this channel trend line strategy. Let me show you something like this. So it's always mostly in a channel where we have, if it's in a bearish market, you have this channel one. It's a chart pattern. This whole channel entry stuff, I cannot remember it. Channel two. This is a bearish market. I think it's what some people call falling wedge or something like that. So you see something will happen like this. This is a bearish market, for instance. You see how price is going to start dropping, reacting to this trend line like a resistance. This trend line now is actually a resistance, and this other trend line below is a support. So you can see that price is not actually breaking out from these two levels. What do you think price is doing? Is creating liquidity on the both side here. So most of you that trade it is actually going to be like you're trading this channel, this falling wedge or something, and at the end you see how price comes up like this, and you now see you have a breakout. Oh, you want to enter, price actually taking out liquidity, then it continues selling again, and by then you're not in for a buy trade. Then you see how price continues selling. So that's just the second type of liquidity to look at this level here. So this one is actually a trend line liquidity, and this mostly really occur in a smaller time frame or any time frame. But you see that price, obviously and gradually, price obviously built this liquidity on this trend line. It did not break this trend line for a very long time, so it built liquidity above here and later ran into it before dropping. That's for the bearish side. So it might not really be a channel like this. Sometimes you can just have a normal bearish market, but you see that in a normal bearish market, price is still going to construct a liquidity, a bearish liquidity. Let's just say we have a bearish market like this. We have a bearish market like this. Sorry, let me delete this guy. We have a bearish market like this. Sorry guys, we have a bearish market like this. And in this market, price needs to go lower, but for some reason, price cannot actually go lower. So something can actually happen like this, which is this other first type of liquidity one I'm telling you about, where price will actually build liquidity on both sides in order to get liquidity to push down. So price can actually choose to do this liquidity one here. This is liquidity one, this is it here. So price can actually choose to do something like that, where it's going to build liquidity on both sides. Sorry, build liquidity on both sides, taking out this constructed liquidity here above this high, above this high, something like this. I want to get the diagram right. Sorry, taking out this constructed liquidity, which is also an inducement because it's within a range, the range of old um this old high and this old low. So this is an inducement or a constructed liquidity. Most time inducement are just a very simple top old high, but the one price gradually constructs is this engineered liquidity. Then for some reason now you then see something like this. Let me show you continue from this um range or this price action. Then you then see something like this price going in. Then you're expecting price to actually continue bearish, but you see something like this: go in, come down, go in, come down, go in, come down, go in, come down. go in, come down. Now, what do you think price is doing? Price is actually building a liquidity above this trend line. We have this to be old highs, old highs, old highs, old highs. So price is actually building a trend line liquidity. So this process is the act of constructing an engineered liquidity. Then before price can now push down lower, this is what price is now going to do. Price is now going to push above all this constructed liquidity to this level before running down to the final objective to take out this liquidity on the old low. That is just the whole aim of the price action, to take out liquidity on both sides. So this is what happened too in a bearish and a bullish market. The same process, the same scenario. In the same scenario where you have bullish market, price is actually going to construct more bullish. When you have a bullish market and you see that price cannot go, price is actually going to try to create liquidity like this, something like this. So you see that when you just see this, when you just see this kind of structure in the market, just know that the algorithm is actually creating liquidity on its own, and you will have to wait for this market patiently, either to enter below this low. So this is the constructed liquidity that price have created here. And because you have an idea now after watching this video that this is a constructed liquidity, you want to see price mitigate this liquidity like this up to 70%, because we need enough price to, enough action to price. We need enough petrol to move price action like this. So you want to see price running to the liquidity up to 70% before. Sorry, let me draw this thing right. You want to see price running to the liquidity before going up. So this is a constructed liquidity. This is a constructed liquidity on both sides. Yeah. And this is also a constructed liquidity, constructed liquidity, liquidity that price intentionally built on its own, constructed liquidity. And the inducement can also be a kind of constructed liquidity. But if you see, this one was not obvious. This one was not actually obvious. It's just a high, low, high, low, high, low movement. So these are inducements, although it's still constructed by the algorithm. So this is where I'll be stopping on this video. Maybe in the next side of the video, which has to do with the identification of mitigated area, how to understand or how to identify a liquidity sweep. Yeah, how to know liquidity mitigations have been occurred, how to know when price and sweep liquidity. I'll be showing you these types of liquidity on the chart. Then I'll also be identifying the place or levels that liquidity has been taken. I'll also show you how to understand or how to identify those liquidity sweep. Yeah, those mitigated areas, those liquidity mitigated areas, something like that. You just know what I'm trying to say. I just want you to watch them step by step. So the third part of the video is still going to be on my channel, and do well to share it amongst your friends, let them understand this whole liquidity concept, especially the one that have to do with the inducement. It's something that is very, very complex. And I believe with everything I've said in this video, you really have to understand inducement. And if you have any question, please do well to ask on the comment section. Like, share, subscribe if you've not yet subscribed. So do well to help me grow this channel too. Yeah, alright guys, this is where I'll be ending this video for today. I've already said a lot. Liquidity is very broad, we can't talk about liquidity, so I have to do it in batches. So the identification of liquidity is going to be in the third video. So watch out for the third video. I'll be dropping it soon on the playlist also. Thank you for watching to the end, and do well to subscribe. Please do not forget to share the videos with your friend. Thank you.